I'm excited to present our 30-second investment offering, which is Avondale Commons, located in Phoenix, Arizona. It's in an area called Avondale. It's probably located 15 minutes from the downtown. Here's why we fell in love with this deal, and here's why I think you guys will really consider this to add to your portfolio. Number one, not all off-market deals are created equal, but in this case, this was literally not going through a broker at all. Because of our personal relationships with the builders, we were able to secure this completely off-market, and it's a major discount. Like, this is probably one of the biggest discounts we've ever got on a project. We were able to do this and act very quickly. We showed them assurance that we can take care of this, and also there's no bidding wars, which is very typical in the Phoenix environment. Number two, by us getting this position in this deal, we're essentially getting it below construction cost, which means that our investors are essentially protected, because if we end up selling it for what we built it for, that will essentially guarantee their capital and a decent return. We think it's going to go even higher than that, but that's already built in. This is an area that's called the Path to Progress. It's part of a larger planned community. There's going to be mixed use, and this is the apartment anchor of the mixed use, and all of that's already being developed, including Starbucks and restaurants and retail. Across the street from this project is one of the largest children's hospitals in Phoenix. As you know, there's a ton of demand. More and more people are moving to Phoenix, especially this part of Phoenix, and there's going to be limited supply. And then we have another project probably 15 minutes away in a place called Peoria. And so the property management company that's going to manage that will manage this. And so there's a lot of synergy, what we call economies of scale. So we can share resources, employees, team members, so we can run both properties very tight.
Here's our offering summary. See, total units 324, build price over 122 million, nearly 123, debt 67.2 million, total equity 55, almost 56 million, interest rate 7.5%. Our hold period is 5 years. And you see on the left side is the total cap stack. On the right side is going to be relevant to this raise. So 25.5 million in total Viking equity, which will make 19 million in Class B and just over 6 million in reserve class. We're really getting an amazing cost basis, as Vic mentioned. We're acquiring at 286 per door, as opposed to the nearly 380,000 to build new, which represents a 21% discount, almost $30 million. Typically, to get a property this new in this area, you're getting a construction deal with zero cash flow over the whole period. Here, you still have a lease-up period, so cash flow is not going to start immediately, but there will be cash flow over the deal, and lease-up is going to be underway in the next couple months.
Yeah, put it another way, in order to get a brand new building, typically you have to build a brand new building, right? You have to start with dirt and end up with a new product. Now, we do that. We do it on other deals. There's a lot of value to create, but obviously there's a lot of work and risk that gets involved that has to be priced in. Here, we have the opportunity to walk in to a nearly completed, brand new top-of-the-line construction, benefit from all the value and lease up, and go ahead of people who were in before us. So it really offers the best of both worlds.
The groundbreaking happened December of 2022. You can see where the first equity raise was, where the delivery of units closer to where we are today. We're going to get through stabilization. We're going to be raising the capital for the new fixed rate loan and getting through stabilization with a projected sale date of 2030, which gives it enough time to build the NOI needed and also navigate to a time where cap rates are favorable for exit. Okay, so the investment structure. So for those of you who are familiar with Viking, typically we have three classes: Class A, Class B, and Reserve Class. For this deal, due to the stabilization period and the lack of immediate cash flow, the 10% Class A, no back-end Class A structure is not available on this deal, but we do still have Class B and Reserve. Class B is going to have a 7% preferred return and an 80-20 profit share, with the LPs getting 80% and the GP getting 20%. The minimum investment for Class B is $50,000. Reserve Class, you're getting a bump, 8% preferred return, and you're capturing 10% of the GP's profits. So you're getting a 90-10 split. The minimum investment for Reserve Class is $500,000. Here we're going to go over the capital stack. So you can see the current equity in the deal. So these are the original investors in the development of this property over the last several years, $30.25 million. Then you have what Viking's bringing to the table through this offering, just $25.75 million. And then the debt structure, $67.2 million. The total purchase price is going to be $123,205,000 with the debt and equity seen here. Class B and reserve that we went over on the previous slide, you can see the preferred return, 5-year hold, the equity multiple for Class B, 1.89%. It shifts to 2x for reserve class, getting that extra 10% of the promote split. The average cash on cash over the 5-year hold is 6.9%. And the average annual return for the respective classes are here, 17.87% and 19.78%. Here we're going to be walking through both a Class B investment and a reserve class investment. So one thing to keep in mind is that because of the stabilization, we anticipate distribution starting in the beginning of 2026, so January of 2026. When that begins, you're going to start out with a 3% cash flow and trail up to 7% over year 5. Here you can see what the annual distribution would look like on a $100,000 investment. And then at disposition, we expect the 80-20 split to yield $54,850 on that same $100,000 investment, getting you your 1.89% exit or $189,359. For reserve class, you're getting the same cash flow, but with a $500,000 investment, you're getting an increased amount. And the equity split is a little bit more significant, $321,944, just closer to 2x return. So here we have the sensitivity analysis. Really, this is showing the target exit cap rate. And as you go expand and compress that cap rate, what it does to your IRR, equity multiple, and average annual return. This is specifically for Class B. And the next slide will be for reserve class.
So this is the pro forma you've seen on a lot of our webinars. The big difference here is I don't think you've ever seen a big of a jump between year 1 to year 5 NOI. And that's because we're walking into a building that is already built, but not leased up yet. So what we will be doing in the forced depreciation, which we will be working through on this property, is lease up, right? And that's really a multi-year process. There's the initial lease up where you might be offering some sort of concessions to those moving in. And then there's, as you'll see on the top lines, that goes down as you optimize for top of the market rents, stabilize with efficient operations, and prepare for exit. So here, we've never created this much value on an as-built product before, and it really is a great opportunity for Viking. And again, a lot of numbers here. Happy to walk through any of our investors who want to better understand them. Okay, the loan here at $67.2 million is actually less than the loan in place now, because what we're doing is we're bringing a lot of our money to help what's called right size the loan. In other words, reduce leverage. This is the initial financing. That's a construction loan, fixed rate. That's why it's 7.5%. That's going to get us through lease up, after which we're going to put agency financing on it. In order to make sure that we are not risking a cash in refi of any degree, significant degree, we are reducing the loan that's in place now to minimize the risk, reduce the risk, take out a lot of the uncertainty so we can execute our plan of not only leasing it up, but it's stabilizing it as well. So we're walking into a fixed rate loan, 30-year amortization, only interest for the first 3 years, and after which will be in an agency loan once stabilized, take us through that optimization until exit. The amenities here are phenomenal, right? Not only do we have the typical gym, pickleball courts, the pool, kind of the common area, hangout rooms, and the clubhouse, but we're talking about state of the art, right? There are EV charging stations, and there are also more EV charging ports that can be built in the future. This property is really expecting, especially given the tech hub surrounding this property, to be on the forefront. So we are prepared for, if we had 75% electronic vehicle in this property could handle it already. So it is here and ready for the growth. We buy a lot of properties. There are some properties where I say I could live here tomorrow, and this is one of them. A good rent profile, tenant profile, floor plans. We're about half 2s and 3s, and the other half 1-bedrooms. We expect there to be a large concentration of kind of young professionals, just given kind of the good nature of the area, and there are some grown families as well. We expect the 2s and 3s to be equally as competitive. And you have apartments, and then you have these triple-decker floor plans in the townhomes with garages, 1-car garages, 2-car garages. Really, really nice units. Competitive in the market as well. This is a great map right here. The left side is our property. The right side The developer already owns the land. They're already under construction. You have retail on the forefront, already a Starbucks lease in place, going to be a Starbucks drive-through. And they have all those leases out in negotiation now for really high-quality retail, walking distance to our property, and it continue to just drive more attention development to this area. And then you'll have mixed use on top. Right now, hospitality and perhaps a small office property as well. And it really all this lends to a really nice master plan, mini master plan, I call it, area, giving our tenants the ability to basically have some of these retail spots at their disposal while we won't have to maintain it. And as I spoke about, some good leases already in tow with the retail and hotel. There's medical office nearby that'll pair well with the Children's Hospital across the street. So this is really becoming, the development you want to see around you is already in action, already being leased, and we're just happy to be a part of it.
Yeah, the type of people we expect to inhabit this property are going to be families, tech, workers, manufacturing workers. It'll be nurses, doctors, and then probably people in education, right? Ed and med, as we like to call it.
And this is a really good description of the path of progress. You have really great developments, really good attractions, all within immediate proximity. I visit the Boulevard. It gets $2+ million a year. There's a sports complex. There's kids' activities. There's a great place to eat, all within a short distance to our property. Again, this is when you have amenities of being in a great area that you don't have to pay for. We have extremely high traffic counts going by this property. What that means, it reduces our leasing costs. You don't need to blast online locators and online ads when you have, almost 250,000 people driving by our complex every day. I'm sure all of you in your neighborhoods know all the apartment complexes on the main roads. You don't need to look them up online, whereas the ones in the back roads are a little harder to find. Young ages, still a good amount of families, very low unemployment. So again, this is basically another way of freezing what was the last slide of all the positive demographics which contribute to a successful apartment community.
Phoenix is one of the number one net absorption of multifamily units. That is because what creates absorption? What creates people wanting more demand of apartments? It's jobs. It's people moving in. So positive net migration, number one. And number two is a lot of jobs. There's an insane number of jobs now happening in Phoenix, probably anchored by like the tech sector, right? The semiconductor manufacturing, the logistics components, obviously tourism, the medical sector, education. All of it gets stacked. Phoenix is the 5th largest city in the United States, number one city in multiple sectors. So the population of Phoenix has grown, 4 times the national average. 2040, they think is going to hit closer to 9 million. It's really starting to really take off. And the interesting thing is you've heard all this job growth, job demand, and companies moving, people moving in here. Then you've heard the population, again, growing. But combine that with, hey, Phoenix itself has 3 restrictions on building more things, more apartments, more land. Because of the water access, there's only certain areas where they can supply water to, and so that's limiting how much construction can happen in Phoenix. Number 2, there's Native American reservations all around Phoenix where you're not allowed to build. And number 3, there's a lot of mountains where it's not feasible to build as well. So decreased supply, a ton of increased demand. You know what's going to happen to valuations and prices and rent growth. Here's the top employers: Banner Health, which is a major medical center, 55,000. Amazon, Honeywell, American Express, St. Joseph's, Arizona State, all of them, Wells Fargo. So the CHIPS Act was passed, I think, in 2022, maybe 2023. And it was really passed by Congress to essentially protect us from the technology race we're in with China, where we need to start creating our own chip. And so there was, I think, a $50 billion allocation for manufacturing facilities all around the United States. Probably up to 50% of that allocation is probably in Phoenix now. And so Intel, Taiwanese Semiconductor are really spearheading all the growth of that. With my physician background, everyone knows the Mayo Clinic. It's one of the top clinics in the world. And obviously outside of their Mayo Clinic, in their headquarters in Rochester, Minnesota, this is the second major facility for them, which is in Arizona. $4.7 billion impact. So this specific clinic. Tons of higher education, University of Arizona, ASU, and all down the road. Amcor is a chip manufacturing, $2 billion multi-phase investment. So this is interesting. This company, SoftBank, is a technology company, and they put together a proposal, and they're in early stages of trying to build a $1 trillion AI and robotics complex. Essentially, it's going to be the top robotics AI complex probably in the world. And they're projecting it to happen in Phoenix. And so they're in early stages of discussions of that right now. Amazon expanding its footprint. Phoenix Sky Harbor is becoming a busier and busier airport. 130,000 passengers a day, 1,200 flights, $44 billion impact. State Farm Stadium hosted Super Bowl, $24 billion in economic impact per year. Electric vehicle manufacturer, $100 million impact. They're also manufacturing their newest vehicle. I think it's called the Gravity. That's their SUV that they started manufacturing here again in Phoenix. What is this deal about, and what does it entail, and why is it interesting, I think, for you guys as investors? It's essentially you're buying something new for a used price. You're able to essentially take a deal which has zero cash flow, and essentially it's going to have cash flow in the next 6 months. It will start having cash flow, and it will keep steadily escalating over the whole period. The other thing is you're buying built-in $30 million of equity, which is hard to do and is highly unusual, and it essentially de-leverages or de-risks the investor. And then really no construction or entitlement risk, but you're getting all the benefits of a new development. And finally, it's really, you're capitalizing on these dislocations in the market. These are the deals where you just wait and wait and wait, and when you finally find that really good deal, you know how they say you make money when you buy, not when you sell? This is that. This is when you made your money when you're buying it right like this. If you wanted to join us, which we think this is going to fill up, and I think a lot of people are already showing interest in it, but there are multiple ways to get involved. Self-directed IRA, you can invest yourself, or you can combine with other folks and get better economics and create a fund. If you're part of a trust or you have a trust, you can use that to invest. And if you have a sale of a deal, 1031, for example, you can bring the 1031 and exchange it into this, potentially either this deal or some of the other deals we have. In summary, 324 units. Avondale is a submarket within Phoenix, which is affluent suburb, 2025 built, 17% IRR, 21% average annual return, up to a 2.2 equity multiple, and it's open to accredited investors.
This is a unique deal. I anticipate having a lot of one-on-one conversations with everyone that joined the webinar. Thank you so much for joining. We're here to help everybody understand how this works, where the risks are, where the soft spots in the deal are, and hope to talk to you soon.